If you laid your brain out on the table right next to your investment portfolio, would they match? If you're a business owner or an entrepreneur who's making more money than you've ever made, or you're sitting on a windfall of cash, or you're afraid that your money isn't working for you the way that it should be, you've probably asked the most frustrating question in wealth. Where do I invest this? Because the truth is, once you've built wealth through entrepreneurship, you start realizing traditional investing advice sucks. But today, I'm going to show you why your biggest edge in the market is not your capital. It is your certifiably insane, burn the boats, see every obstacle as an opportunity, built different entrepreneur brain. So a while back, I heard Alex Hormozi tell the story of how he started acquisitions.com. Now, if you're an entrepreneur, you're a business owner, and you care about growing companies, Alex Hormozi is one of the most gifted marketers and business builders in the world today. He built companies like Gym Launch and Prestige Labs, famously exited those for somewhere around $100 million, and then he hit a very real crisis of meaning. Because when the check cleared, he realized something that most people never think about until they get there. He had built wealth doing one thing really, really well. He understood business, he understood customer acquisition, he understood paid advertising. He understood how to build a machine where you could put $1 in and get multiple dollars back out. But once he had the money, he realized he didn't actually know what to do with it. Now, all these people are telling him, hey, put it in real estate, put it in oil and gas, put it in S&P 500, put it in fixed income. Hey, you should do venture capital. He had 100 different opinions that were coming at him from 100 different directions. And by his own admission, he was completely confused because the only way that he had ever really known how to make money was by building businesses through paid advertising. Then he tells the story of hearing one line on a podcast. And ironically enough, it was from Dave Ramsey, of all people. And the line was this: if you laid your brain out on the table right next to your investment portfolio, would they match? And that was the moment for Alex. That was the wake-up call. He realized, I don't need to go and chase a bunch of investments that I don't understand. I need to invest in businesses. I need to own pieces of companies where I can bring the exact skill set that made me successful in the first place. And that realization, that wake-up call, became acquisitions.com. And since then, everything that Alex has done has essentially fed that machine, the books, the content, the podcast, the brand, everything funnels toward finding the right businesses where he can invest capital, he can take equity, and he can help them scale using the things that he understands best. Now, that story always makes me think about Warren Buffett too, because Buffett, he said he wants to invest in businesses that are so wonderfully simple, understandable, and durable that an idiot could run them and then put great people in place to run them. It's a different style, it's a different personality, but it's the same principle. The best investors tend to invest in things that they actually understand. And that exposes a huge problem that a lot of entrepreneurs run into, especially once their business starts producing serious cash flow or they've had some kind of exit. And now, for the first time in their life, they're sitting on more liquid capital than they've ever had before. And suddenly the question becomes, well, what do I do with this now? How do I grow it? How do I protect it? How do I make sure that I don't lose what took me so many years to build? And a lot of people experience basically what's called sudden wealth syndrome. You spend years grinding and sacrificing and building and risking and solving problems, becoming excellent at one thing. And then one day it works. The money starts showing up. The wins, they start stacking up. And right after all that excitement comes a different emotion. Holy crap. What now? Because the only thing you've really known how to do up to this point is the thing that created the wealth in the first place. Maybe it was software, maybe it was sales, maybe it was paid advertising, maybe it was real estate, maybe it was operations, whatever it was, that's the language that you speak. That's the game that you understand. And what most entrepreneurs do not realize is this: they actually have a massive advantage in the world of investing, but only if they choose the right strategy and the right vehicle. And here's where many of them go so wrong. They finally decide, okay, I need to diversify. I need to invest outside of my business. And so they hand the decision off to some generic financial advisor who makes $103,000 a year, has never built any wealth themselves, who puts them in the same framework as everybody else. And that's the mistake. Because now the person who thought differently, man, risked differently, built differently, won at a different game, ends up getting stuffed back into the same box as everybody who never operated that way in the first place. You got a business owner who built real wealth through courage, through conviction, through skill, through thinking outside of the box, asymmetrical thinking. And now they're being told to approach investing with the exact same plain vanilla framework that was built for the average person. And you and I, we're not average. That doesn't make any freaking sense. The entrepreneur's advantage is not that they should avoid investing. It's that they should invest in ways that actually fit how they think, what they understand, and where they can create an edge. And that's the real question. What do smart entrepreneurs invest in? Certainly not just what's available, not just what's common, not just what some, advisor says is balanced and conservative, but what actually makes sense for a person who already knows how to build, how to scale, how to evaluate risk, and how to create value. This is where the average investing conversation starts to break down, because we already know that as entrepreneurs, we think differently, we build differently, we create value differently. So we have to ask the question, shouldn't we also invest differently? And Tony Robbins has made this point in a way that is impossible to ignore. In The Holy Grail of Investing, he points to a striking long-term difference between private equity and the S&P 500. He says that from 1986 to 2023, private equity returned 14.28% annually versus 9.2% annually for the S&P 500. And he couples that with another big idea. He says most sizable businesses in America are still private, which means a huge share of wealth creation never even shows up in the public markets that most people are trained to focus on. Now, again, I'm not saying that means every entrepreneur should run out and throw a bunch of money into private deals. That's not the point. The point is that those numbers should force a question. What do sophisticated investors see in private markets that the average person doesn't? Why do so many smart operators move from simply building businesses to owning pieces of more businesses? And why does that path seem to make so much intuitive sense for people who already understand risk, cash flow, operations, and value creation? Now, Tony explains the impact, the long-term impact of this in a short video clip, and he explains it better than I can. So watch this video clip real quick.
Let's do this. Try this for the people at home. In the last 39 years, if you put your money in the S&P 500, it's averaged 9%.
Okay.
So if you put $1 million in there, at the end of this time, you'd have 28.6 million. If it's 100,000, it'd be 2.86 million, right?
Yeah.
But if you put in average private equity, it's been every stock market in the world, average private equity, not the guys I'm talking about.
Yeah.
Average private equity has averaged 15.7% per year around the world. 75% higher per year, compounded year after year.
Yeah.
You put in that same $1 million, instead of 28 million, you have 293 million.
More.
10x. Okay, forget your 3% worries you're talking about. Screw that.
All right, so now let's dive into the real meat of it, because the real issue is not whether private equity is trendy. The real issue is whether investing like an owner produces a fundamentally different outcome than investing like a spectator. Now, for me, this wasn't just a theory. This has actually been my actual journey. I started my first business when I was 11 years old. It was a landscaping business. I started it to help my mom, who was struggling financially. And from age 11 to age 26, that was my world. That was where I learned how to work, how to sell, how to serve people, how to solve problems, how to manage cash flow, how to lead, and how to build something out of nothing. And then at age 26, I exited that business. After that, I stepped into a very different season of life. I spent time doing missions work. I started expanding my thinking. I began asking bigger questions about purpose, about stewardship, about impact. Questions like, what is wealth actually for? And like a lot of us entrepreneurs, I started investing in the ways that were most familiar and most accessible. I invested in some real estate, but primarily I started trading in public stocks. I explored the normal paths that people with a little bit of capital eventually start looking at. And then life has this way of forcing clarity on you. When my son was 9 months old, he had a stroke. And it was one of those moments that just stopped everything in my life. It was a huge wake-up call in every sense of the word. It shook me to the core. And ultimately, it ended up recentering me. It forced me to confront how fragile life is, how precious time really is, and how dangerous it can be to drift into a life or into a strategy that looks responsible on paper, but slowly puts you back into a box that you were never meant to live in. Because if I'm honest, I started forcing myself into a box, a smaller box, a safer box, a more conventional box. And that moment woke me back up. It made me step back and ask the question, what am I actually building? What kind of life am I trying to create? What kind of investor do I need to become if I actually want the freedom, the flexibility, the cash flow, the impact, and the ability to be present for the people who matter most to me? And that's where private equity started making more and more sense to me. Not private equity as some abstract Wall Street term, but private equity in the real sense of the word, buying ownership in real businesses, in cash flowing assets, in things that I could understand, that I could evaluate, and that I could help create value in. And in that big world of private equity, real estate made the most sense to me as a starting point, because multifamily and commercial real estate, they're not just properties, they're businesses, wonderfully simple businesses in many cases. You have revenue, you have expenses, you have operations, you have management, you have inefficiencies to solve, you have value to create, you have upside if you know what you're doing. That made sense to me. It fit the way that I think, it fit the way that I evaluate risk, it fit the way that entrepreneurs naturally see opportunity. And so from there, as I kept growing and learning, I realized I didn't want to stay concentrated only in just one lane forever. So yes, real estate became and still is the foundational core piece of my portfolio, but to diversify within the broader world of private equity and alternative investments, I've also invested in and launched funds into oil and gas acquisitions, into private credit, and I'm actively researching other alternatives as well. Because the goal was never to just chase after random deals. The goal was to build an investment approach that actually made sense for me as an entrepreneur, an approach that was rooted in ownership, in cash flow, in understandable businesses, in asymmetric upside, in strategic diversification, and in investments that don't force me to disconnect from the way I already know how to create value or the way I already know how value is created. And to me, that was the biggest shift. It wasn't moving from entrepreneurship into passive spectator investing, but it was moving from building one business to thinking like an owner across multiple businesses and multiple asset classes. So as we land this conversation, I want to make it really practical, because the goal of this episode is not to talk about how there's only one right investment for every entrepreneur. It's just not true. The goal is to help us ask better questions. Because for a lot of us as business owners, the problem is not a lack of opportunity. The problem is that once we finally have meaningful capital, we stop trusting the part of ourselves that built that capital in the first place. We get more cautious than we've ever been before. We get more hesitant than we've ever been before. We get more easily influenced than we've ever been before. And suddenly the same people who are willing to risk years of our lives building a business from scratch become afraid to make a move unless some polished person in a suit blesses it first. Why? Well, because now the risk feels different. When we were building the business, we believed in our ability to influence the outcome. Now we're being told to put money into things that we don't understand. We can't evaluate. We have no real ability to influence. And then we're told that's the responsible thing to do. But for entrepreneurs, that usually doesn't create peace. It creates anxiety. Because deep down, we know when we're disconnected from the thing, when we don't understand what drives the returns, when we don't understand what makes the good deal good or the bad deal bad, when we don't understand the operator, when we don't understand the risks well enough to know whether they're real risks or if they're just risks that can be managed well by the right people. So let me give us 3 questions to ask. 3 questions that every smart entrepreneur should ask if we want to figure out what our best next step in investing actually is. The first question, what do we understand well enough to assess with confidence? Not what's trendy, not what everybody in the internet is talking about, not what our buddy made money on last year. What do we actually understand well enough to assess it with confidence? What kind of business model makes sense to us? What kind of operator makes sense to us? What kind of revenue makes sense to us? What kind of risk makes sense to us? Because if we don't understand the engine, we're always going to feel fragile around the outcome. And that fragility often gets mislabeled as wisdom. Sometimes it's not wisdom. Sometimes it's just unfamiliarity. Sometimes what we call being conservative is really just being disconnected from the investment. That doesn't mean we only invest in our exact industry forever, but it does mean a wise next step usually starts with something adjacent to how we already think. Something where the value creation is understandable, something where the risks are visible, something where we can look at the operator, we can look at the model, we can look at the moving parts, and we can say, okay, I get this. This makes sense. And the second question is, where do we have a natural advantage in judging opportunity, operators, or outcomes? Because one of the greatest mistakes that we make as entrepreneurs is acting like our unique advantage disappears the moment we stop actively running our own company. It doesn't. Our pattern recognition still matters. Our ability to read people still matters. Our understanding of incentives still matters. Our understanding of cash flow and operational excellence and growth levers and bad management still matters. We may not be the ones running the investment day to day, but that doesn't mean that we're supposed to shut our brains off. We should be asking, where do we actually have an edge? Do we understand real assets better than abstract paper assets? Do we understand businesses with simple economics better than complex financial engineering? Do we know how to recognize a good operator from a bad one? Do we know how to evaluate whether a result is driven by skill, timing, leverage, or just plain luck? Because the more we invest in areas where our own judgment matters, the more likely we are to feel conviction instead of confusion. And conviction matters. Not reckless conviction or ego or blind confidence, but grounded conviction, the kind that comes from understanding the thing that we're looking at. And the third question is, what's one sensible next step that gets me moving without forcing me to know everything today? And this one might be the most important one, because some of us hear a conversation like this, we're like, all right, Caleb, I need to figure out my whole portfolio strategy for the next freaking 30 years by Friday. Dude, no, you don't. You just need a sensible next step. One move that gets you out of paralysis, one move that gets you learning, one move that gets you closer to alignment between your brain and your portfolio. Now, for me, real estate was that sensible starting point, because multifamily and commercial real estate are just businesses. They're not magic. They're not abstract. They're not impossibly hard to understand. They're businesses with revenue, expenses, management, inefficiencies, risks, opportunities, and value creation levers. That's the kind of language that I already speak. That is the language that entrepreneurs already speak. And because of that, I think real estate is one of the most sensible starting points for a lot of us as business owners who are trying to move from simply earning wealth to stewarding and multiplying wealth. Not because it's the only answer, but because it's often an understandable one. And sometimes the best next move is not the flashiest move, it's the clearest move. And it's the one that helps us to start building a framework, to start building pattern recognition, to start learning how to evaluate operators, to start understanding what drives real outcomes, to start getting our capital into motion in a way that actually fits how we are wired. And that's the whole point. We don't have to force ourselves into an investment style that makes us feel blind or passive or disconnected just because somebody told us that was the responsible thing to do. Well, that's what responsible adults do. We also don't have to be ruled by risk intolerance that magically showed up only after we finally had some freaking money. We weren't built by playing scared. We didn't create wealth by thinking like everybody else does. And we don't need to start outsourcing all of our judgment now. We need wisdom, we need discernment, we need patience, we need learning, we need good operators, we need real due diligence. But we also need to remember this, dude, the same mind that built the business may be one of the greatest assets that you have in building the portfolio. So let's ask better questions. Let's take a couple of real, sensible steps. Let's start with what we can understand, and let's build from there. Thanks for watching On the Exit.